Welcome to the Wealth Study Podcast. This is episode 465. Today is March 5th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. We got a lot to talk about today. I want to cover the volatility that we've seen over the past few weeks and put that into some perspective and context. One of the major drivers that I believe that has pushed the stock market down has been simply negative investor sentiment. Now, specifically in terms of investor sentiment, there's a very popular one out there. It's put out by the American Association of Independent Investors. And as of last week, it had hit one of the most negative levels in history. Now, this survey will come out again tomorrow. In fact, I may put a blog post up about that just to show you the chart. That survey was so negative last week that if you go back over the last 25 years, it was the fifth worst survey over that period, right? So over the last 25 years, that includes the dot-com bubble, the great financial crisis, the pandemic. I mean, all the things that you can imagine that have happened, September 11th, terrorist attacks. I mean, every bad event in the last 25 years, when you line them all up, supposedly, according to that survey, last week was the fifth worst week in history. Really? Are things that bad? Maybe where you live, but certainly not in the world I live in. So I will be very interested to see what the numbers come out for this week. But it's been my experience that when things get that bad on that survey, especially when the fundamentals are so strong, I would really look at that as a low point and a time to buy the dip. And so why are investors so scared and so worried? And it's simply because that's the media narrative. And it isn't helped by the fact that President Trump thrives on chaos. That's his modus operandi. You know, Trump is amazing with his ability to manipulate the information that he wants to present. And that's not necessarily a compliment, but you just need to know how to read him. And he, in my opinion, purposely creates chaos, much like a little kid with it, throws a tantrum to get what he wants. Well, Trump has a version of that where he either throws a fit to get what he wants, or he's that quintessential magician that is distracting you and having you look at his left hand while his right hand is really what's doing all the business. And the media plays up on that, and my advice would be just don't get caught up in the smoke screen. See through all the smoke and mirrors. Look at what's actually taking place, not either what Trump is saying or how the media is positioning what Trump is saying. Just wake up every day and imagine you're watching a reality TV show. Because the information that you're hearing from both sides is so distorted that you have to really pick through it with a fine-tooth comb to see where the reality is. And so while all these consumer sentiments are negative, everybody's worried about inflation, everybody's worried about the stock market falling apart, let's look beyond the surveys, let's look beyond what people are just saying. And if we look at pretty much in the traditional volatility index of the S&P 500, that would be the VIX. And what the VIX is telling us is that even though investor sentiment is so negative and investors are telling us that this is one of the fifth most worst times in the last 25 years to be invested in the stock market, if you actually look at the measured volatility gauge based on the put-call spreads, then that reality check actually shows you that true investor sentiment really isn't that bad. Over the last 5 years or so, whenever the market hit some real turbulence or some real extreme volatility, the VIX would spike over 30. But so far year to date, last week included, we've been nowhere near 30. I think the highest point for the VIX so far in 2025 has only been around 26. So we're not even near the low end of the pressure point of 30. So I think that's a solid, measurable data point that you can use as a reality check instead of just looking at these investor sentiment surveys, which are just nothing more than opinion. Look at the numbers, look at the data. Yes, it is elevated. It has been elevated over the past few weeks, but it's nowhere near an extreme. Another thing to look at is simply the performance of the markets themselves. So looking at the actual S&P 500, yesterday it bounced off of its 200-day moving average. That's the lowest it's gotten all year. That's actually, in terms of relation to the 200-day moving average, that's the lowest it's been since November of 2023. So the S&P 500 has been doing extremely well for the last, 2.5 years. It's been significantly above that 200-day moving average through most of that time. And as of yesterday, it didn't break down below that. That's always a very good sign. And in fact, it's one of the best signs you can look at, because what happens is, although individual investors, retail, mom and pop investors are panicking, we know that by the surveys, the smart money, the people that control the institutional retirement money, the big hedge funds, they're coming in and buying when the market dips down to a major moving average like that, 150-day, 200-day moving average. They're coming in and buying on those dips. That certainly happened yesterday according to the charts. And as of right now, it's trading above that. So we'll see if that support level holds. But if it does, that could mean that we've put in a bottom for this period. And even if we haven't, the point I want to make is that despite all the turbulence, despite all the negativity, despite how much the market has dropped just over the past 2 or 3 weeks, if you look at it year to date, so just going back over the last 2 full months, the S&P 500 is only down, as of right now, as I record this, less than 2%. So again, reality check, looking at the data, despite how bad all the news is and how bad all the investor sentiment is, things really aren't that bad. It could get a lot worse. And personally, right now, the way I'm reading things, I don't think it's going to get much worse. Now, the reason I think that things are getting better is because if we look at the broader market, not just the S&P 500, but the S&P 500 based on an equal weight basis, you can do that by looking at an ETF like RSP. We're seeing that during this very turbulent time, and in fact, through most of this year, the broader market is outperforming the S&P 500. That's a very good sign, because it's showing that under the surface, these individual stocks are holding up and are gaining ground. So maybe Microsoft is sluggish. Maybe Tesla's not doing so well. But those other, 497 stocks on a relative basis are doing better. That's good news. That's something that we've been struggling to see for the last 2 years. And I think maybe we are at a low point for the performance of those 497 stocks. So that's very encouraging to me. So what's driving all this fear and panic beyond the fact that people are just panicking? I think that better performance among these, 497 stocks, and even into the mid cap and to the small cap stocks to some degree, I think that better performance is being overshadowed by the fact right now that we're getting some really mixed results on where future growth is being projected. And a lot of it has to do with what's happening in DC with Trump and Elon Musk and Doge, with the government layoffs and what they're doing with trying to downsize government programs and laying off federal workers. That gets a lot of headlines that potentially could have a really negative impact on the employment rate. And so you're seeing a lot of projections from places like the Federal Reserve of Atlanta, where they're saying we're going to have negative GDP for the first quarter, negative 1.5%. And a lot of that's predicated on the fact that we have these government workers being laid off and the cancellation of government contracts. Now, I don't know if that's going to be true or not, and if it's really going to slow down GDP that much, and if it's going to have such a bad and negative influence on the unemployment rate. But here's the point, and we very rarely, if ever, see mass layoffs of government workers or of, shutting down government programs. And so we don't have a lot of historical data to go by. So you got to take a lot of these projections that people are prognosticating about with a grain of salt. But let's look at it this way. Even if we do get really negative GDP because of the government cutbacks, from a stock market perspective, is that really going to be negative? For all the companies that have very little, if virtually no exposure to government contracts, nor to major areas where there's a lot of federal workers, is it really going to impact those companies' bottom lines? Maybe it won't. And again, we don't have enough data to be able to predict that because we've never seen such a big cutback before. Listen, if you share my ideology, then you should be bullish about the stock market right now, because you would believe that allocating money away from the government and into the private sector is a good thing for stocks, because that means the money is going to be used in a more productive and efficient manner. And if you don't believe that, well, nothing I would say would convince you otherwise, so I wouldn't even try. But look at it from that perspective. Yes, there may be some short-term pain, but if Doge and these other things can do anywhere near what they claim, or even a fraction of what they claim, then I think that can free up some very good capital to be used by small businesses, mid-sized businesses, and even the huge businesses. Look at what BlackRock is out there doing right now, buying ports on both ends of the Panama Canal. I mean, this is really a time where mergers, acquisitions, and deregulations could ignite the stock markets, despite all the short-term negativity we're seeing right now. Now, another thing that's really driving a lot of fear in the market in the last few weeks has been the worry about a reoccurrence of inflation. This has actually been the worry ever since Trump got elected. And while there could be some truth in that, you also have to assume that a lot of it is simply overreaction. One week we get a CPI and it's a little bit higher than usual and everybody freaks out. And then literally in the next week or two, you get the PCI data and it comes in lower than expected and everybody's happy. And listen, the bottom line is that whether something is above or below expectations, the thing to remember there is that it's the expectations that are always wrong. If a number comes in above expectations, it's because the forecasters just simply forecasted it wrong. And when you actually look at the inflation data, I think you'll see what I've been saying for 18 months to 2 years now is that this inflation is sticky. It isn't simply going away, and I don't think we're going back to the low inflation numbers that we experienced through, 15 years after the great financial crisis. We're also not going to see the low level of interest rates that we saw back then. But that doesn't mean that we're headed for hyperinflation. Doesn't mean that the world can't live with mortgage rates that are 5.5% or 6%. Back in the day when I had a mortgage, the lowest rate I ever had was 6%. My first mortgage was at 9%. My last mortgage was at 6%. And I think right now rates are probably about where they need to be. And again, not looking at just what the inflation's measured at, but looking at the real number of interest rates, they've been coming down. The 10-year Treasury is right around 4.2%. The post-election high was nearly 4.8%. There were a lot of people prognosticating that it was going to get to 5% or higher. But we're back down to 4.2. We had been lower than that earlier in the week. So if inflation is really in the cards and it's going to get out of control, why are interest rates either coming down or moderating below 4.5% instead of going above it? Again, this is a hard number that we can look at, a market-based number, not a survey, not an estimate, not a forecast, not something that an economist came up with, but it's actually what the market is willing to pay for 10-year treasuries, and that number is moderating. And along the lines with interest rates, what's really been fascinating, and I'm not hearing anybody in the media talk about it, but with all the geopolitical instability, right now, a lot of which Trump is creating or has created, the chaos he's created, whether it's with the Europeans or whether it's about NATO or Europe or whether it's tariffs on our allies or close trading partners like Mexico and Canada. You would think that with interest rates coming down like they have, that the U.S. dollar might be falling apart too. But if you look at where the U.S. dollar is and where it has been, it remains very strong. In fact, the U.S. dollar is in the top range. It's in the top decile, right? The top 10% of where it's been in the last 25 years. So yeah, it fluctuates day to day, week to week. But for where it is right now, it has seldom been higher than this. You can go back to the 1980s, and there's been few occasions when the dollar has been as strong or stronger than it is right now. So no, the dollar's not losing reserve currency status. No, people are not rushing to sell off government treasuries and securities. And again, even with some of the craziest things that Trump says and does, interest rates are moderately low and the dollar is relatively strong. That's an anomaly, especially the way it's been reacting over the last 3 months. Oftentimes, they move in alignment with each other. The dollar goes up because interest rates go up. And so foreign currencies want to pile into the American economy because interest rates are higher. So higher interest rates, higher dollar. What we're seeing right now is the dollar is maintaining its strength even while the interest rates come down. That's an anomaly. To me, that's very encouraging. And it's doubly impactful and a huge tailwind and very positive for the U.S. economy. Because what it means is that borrowing costs are going down, and yet purchasing power of the dollar is still high or rising. So we can buy raw materials and commodities and foreign products on a relative basis with higher purchasing power because we have a strong dollar, and yet at the same time, borrowing costs are low. When you have low borrowing costs and stable to high purchasing power, then that's the best of both economic worlds, and it seldom gets better than that. And that's what we're experiencing right now. You're not hearing about that anywhere. And the reason you're not hearing about it is because of, again, all the chaos that Trump creates. And I think a lot of it, like that magician, he creates it on purpose. He's creating this illusion to redirect or misdirect people's attention on the wrong thing so he can accomplish the things that he does want to do. Do you really think that Trump wants Canada to be a 51st state? No, but he says that. He says it because he knows he gets under people's skin. And while they're fighting him on that issue, which is nonsensical, he diverts and he gets what he wants in another area. Think about the whole issue with tariffs, specifically on Canada and Mexico. They've been predicated and rationalized on the fact that Canada and Mexico don't have good border security, and so unwanted immigrants and specifically fentanyl is finding its way into the United States. Well, I don't think Trump cares in the least about fentanyl. I think it's a smokescreen. I think he specifically targeted fentanyl as the rationale for these tariffs because security of the border and, movement of fentanyl across the border is very subjective. Who's really going to know if it gets better or worse? And so he can impose these tariffs and he could literally, on a whim, take them off tomorrow because he says that they've tightened down on border security. It's just a tactic. Think of tariffs as a consumption tax. Listen, I don't like taxes any better than anybody else, but I'd rather pay a consumption tax than an income tax. And again, I think that's why long term this potentially could be good for the economy. I also don't think we're going to see 25% across the board tariffs long term on Canada and Mexico. I think it's a distraction. I think it's a smokescreen. But even beyond that, remember the S&P 500 bounced off its 200-day moving average. If tariffs do stick, if they are imposed that high, because it is a consumption tax, then the drain on GDP, while negative, will be fractional. And again, it's a policy that can always be lifted if it creates a problem. So while there's a lot of fear and gnashing of teeth, I don't think it's a long-term problem. And that's the same with the purposeful chaos and conflicts that Trump has constructed with, our supposed European allies and with NATO and his policies on Ukraine. Listen, just step back from all that. I'm not going to argue one side or the other whether we should or shouldn't. I'm not even going to go there. And it's probably not even because I have the opinion you think I do. But the bottom line on my opinion is it would just be my opinion and it doesn't make one bit of difference anyways. I'm going to digress here, but when you start trying to achieve and build your wealth, whether you do it through your career or whether you do it through starting your own business or whether you're doing it through investing, the way you get to the point where you can be financially independent is because you're not worried about all the ancillary things that everybody else is. You're worried about the things that are in your sphere of influence. And anything to do with NATO or Ukraine or tariffs on Mexico are so far outside of my wheelhouse of things that I can control and influence that I just don't worry about them. And the sooner that you put your efforts into controlling the things that you have the ability to control, the more wealth you're going to create for yourself. But I digress. Hey, in any case, listen, all the chaos that Trump's creating with Europe, all the bickering, all the drama in the Oval Office, just look at the global stock market. Since Trump's been elected, and even with the most recent tits and tats, places like Germany, places like China, their stock markets are up double digits. So if there was really a real threat of the Russians coming across the border of Ukraine and invading Poland, do you really think the German DAX would be up double digits? I don't think so. Likewise with China. If China was on the verge of invading Taiwan, would any of the Asian stock markets be doing as well as they are? So look beyond the illusion. Look beyond the smokescreen. Look at the data and what's really happening. And along those lines, I'm going to end on this note. One other thing that you can look at that's a hard number, it's market driven, and it's the price of oil. And this gets back to Trump being the illusionist. I mentioned before about the best tailwinds an economy can have is to have a strong dollar and low borrowing costs. You know what you want to add to that to have a trifecta? That's low energy costs. Trump wants low borrowing costs and low price of oil. And again, I think a lot of the chaos he creates is to move in that direction. For example, he knows the Federal Reserve doesn't want to cut rates. And so if he creates chaos, economic chaos, then naturally interest rates start to come down. Well, look at the price of oil, and in particular, look at what's happening in the oil markets. Trump has talked about drill, baby, drill, where he wants to produce more petrochemicals in the United States. He's also been very supportive of OPEC and specifically Saudi Arabia. We saw just in the last week that Saudi Arabia has committed to increasing production in April, even though global consumption of oil isn't going up at as high of a rate as they estimated. There was some thoughts there that they might continue capping production, but they're not. They're going to overproduce in Saudi Arabia. Trump is talking about drill, baby, drill in the United States. And so consequently, as we're seeing the stronger dollar and we're seeing low interest rates, we're also seeing lower oil prices. And I'm telling you, there's nothing more powerful for an economy's growth than low capital costs and low energy. And on that note, and this is really cynical and again, something I'm not hearing anybody talk about, but I'm observing it on my own. You go back last month to the meeting, I think it was on February 18th. There was the initial peace talks for Ukraine, where delegation from the Soviet Union and from the United States, I think Marco Rubio and I'm not sure who else was there representing the United States, but they had a meeting with the Russians. The Europeans and the Ukrainians were furious because they didn't have a seat at the table, right? They weren't invited. And everybody was complaining, how can they be having peace talks without the Europeans involved, without Ukraine involved? Well, where was that meeting held? Was it held in, kind of a typical neutral place like Geneva? No, it was held in Saudi Arabia. So the United States, the Soviet Union, and Saudi Arabia get together to talk about ending the war in Ukraine. I'm cynical enough where I don't buy that. When I look at that, what I see? I don't see Ukrainian peace talks. What I see is the world's 3 largest producers of oil getting together for a private meeting. And again, what's happened since then? Price of oil is rapidly falling. Saudi Arabia's increasing their production, and Trump is drill, baby, drill. I can't predict the future, but my prediction is that if we do maintain a strong dollar, low interest rates, and cheap oil costs, then the American stock market's going to the moon. Well, hey, is any of that going to take place? Come on back for future episodes and we'll talk about it and find out. Until then, as always, this is John Pugliano wishing you the very best returns.